So you have $1,000 and you're looking for the best way to invest it. Without a doubt, the best way to invest it is in your business. You will get way larger returns if you're successful than you would in a stock market. However, let's be real here. Investing in your own business is very risky and it's not exactly a passive income. As a business owner for 15 years, trust me when I tell you it's a very active income, because you're not only investing $1,000, you're investing your time, your sweat equity, your mental capacity, all which comes with opportunity cost. So for the purpose of this video, I'm gonna assume that you have an active income and you're trying to channel the money to turn it into a passive income so you can relax. And we're going to invest in the stock market, and there's so many ways to do it, but we're going to look at the 3 ways. Number 1, using robo-advisors. Number 2 is using diversified ETF. And number 3, if you're risky and you're looking for those higher returns, we're going to build a little portfolio within $1,000 without using fractional shares, because they come with their own kind of sort of limitations in terms of what stocks you can buy, what kind of fees they use. So we're not gonna cheat by using fractional shares. We'll actually try and fit everything in within the $1,000. Firstly, a disclaimer, I'm a guy from internet. This video is meant for educational purpose. This is not a financial advice. Before you make your own decisions, I highly suggest that you consult with professionals. And this kind of also leads me to the prerequisites. Before you even try to invest $1,000, what things need to happen? Well, number 1, you should not have any high interest debt. Obviously credit card debt, if you have a car loan that is above 4 or 5%, even if you have home equity line that is at 5%, for example, and you're trying to make 7% in the market, perhaps that spread is not high enough to take that risk. Because remember, every investment comes with the risk, even if it's very sound And number 2 is you gotta have an emergency fund. Ideally, you wanna have 6 months of all of your expenses covered. I cannot stress enough how important it is, because it will just give you that mental stability where you're not worried all the time about what's going to happen if you lose your job, or if you have a client like me, what's going to happen if you lose the client. That 6 months kind of gives you that laneway that if something really bad happens, you'll be able to work hard and find new ways to generate cash. Once you paid off your high interest debt and you have emergency account and you have $1,000 extra, you are ready to invest in the stock market. And here are a few considerations that should be on your mind when you evaluate investing opportunities. Number 1 are the transaction costs. Sometimes you can trade for $0, sometimes $6.99. If you're with a traditional bank, it can be $9.99. And then if you're Canadian like me and you're trying to buy a US stock, you might also have conversion fees. So those things add up over the time, and they're very important. Going with the theme of fees, number 2 thing you should be looking at is management expense ratio, MER or MER. I'm not really sure how you're supposed to pronounce it, but it's basically the percentage of all of the assets that be managed by ETF or a mutual fund that you're paying to the company. And obviously, the lower the fees, the more money you end up keeping. So it's very important to keep an eye on that. 3 is diversification. If you want to be safe with your investments, you gotta diversify. And the idea is when you combine multiple assets together, you still get the same returns, but your beta of the portfolio, the risk level, actually goes down. So you have to think about what's the most effective way for you to do it. Number 4, going with diversification, is you need to think about yourself. What kind of level of risk are you willing to incur? Because the more risks you take, the more potentially you can earn. And I'm assuming that you're willing to incur some level of risk, because all of the investments in stock market are risky. If you want a risk-free investment, you better keep your money in savings account or CD or GIC. But for example, if you're a younger person and you have enough time to incur more risk. Perhaps you would like to buy in individual stocks. If you're a person that's older, closer to retirement, and you can't really, you don't have enough time to weather the storm, you might prefer to buy blue chip stocks or highly diversified ETFs. So that's something for you to decide and understand the choices you make on investment, what kind of upside they have and what kind of risk they carry with them. Number 5 is rebalancing. Even if you build an ideal portfolio for this snapshot of time, market forces changes, and sooner or later there is a guarantee that you will need to rebalance your portfolio. So you'll need to decide how do you want it to be done. Do you want it to be done manually by you, by an active fund manager, or by a computer that uses an algorithm? But the bottom line is you need to rebalance stuff. Which brings me to the last item, which is ease of use or interface. Some investments are very cumbersome, some are very user-friendly that will encourage you to save money or even to have the automated contribution. So keeping those considerations in mind, let's look at robo-advisors. This is the first way we're going to discuss in those videos. So those are the companies like Wealthsimple, and the idea is that there's a computer that uses an algorithm that is based on Nobel Prize winning techniques or formulas to invest in the stock market. In practical terms, the computer takes 5 to 7 diversified ETFs already and automatically rebalances them for you at set periods of time. So you get a really nice interface that will entice you to save money, will nudge you. You'll get great reporting, both for yourself and when you have to report to the tax authorities. Just very easy to use. There are a few downsides. Number 1, they're not by default, they're not 100% customizable to you because they're using those algorithms. And while there are some specific options for you, for example, Wealthsimple has a halal portfolio and socially conscious portfolio. Again, by default, if you want really something specific, it will go against the algorithmic sort of investing based on those principles, so you just can't do it. And number 2 is you kind of pay double amount of fees because you pay the management fee to the robo-advisor. So for example, Wealthsimple is 0.5%, and then whatever ETFs they buy, you also gotta pay management expense fee there. So your MER is higher than 0.5% with Wealthsimple. It can creep up to say 0.8%, which is way lower than 2.2 in some average mutual fund, but it is higher than if you would have just bought one ETF, which is the second method we're gonna discuss. So the second way to invest $1,000 is to buy a diversified ETF. If you're looking for absolutely cheapest way to have a diversified portfolio, this is the way to do it because those guys charge around 0.25% and that's it. And ETFs by default are diversified because you're buying multiple companies at once, but diversified ETFs goes one step further because they're buying other ETFs. So it's kind of a wrapper for multiple ETFs at once. For example, here in Canada, we have Vanguard All Equity ETF portfolio. And if you look at their holdings, they spread it between US stocks, Canadian stocks, US stocks hedged for Canadian currency, and even emerging markets. In total, if you buy this ETF, you will own a little piece of 12,645 companies. I mean, that's a lot of diversification. They will also rebalance it for you, both on parent level ETF, and also the child ETFs will rebalance their own assets themselves. So you get a lot of sort of rebalancing and movement and diversification all in one package. On the downside side, number 1 is it's a bit cumbersome to use because you gotta treat it as a trade. So when you buy it, you're gonna have to look at what the stock price is for the ETF, and when you place the order, you really place the order for the number of stocks, and you obviously can't make automatic contributions to that because every time you want to add to that, you have to buy stocks. So it's way less user-friendly than go to Wealthsimple and say here's $50. Now there are some mutual funds that all they do is they just buy the one diversified ETF And if you buy the mutual fund, it allows you to have those automatic contributions, like better reporting, but then they charge the higher management expense ratio. So they basically just buy the same stock for you and they charge you the spread. And the second obvious limitation of that is, if you own a piece of 12,645 companies, majority of them might not be very good companies. So even though your portfolio keeps going up, it could be like 3 or 4 companies that are really pushing it up, like Google and Apple and Amazon, and then there's like 10,000 of crappy companies. And obviously you have like really no control over it. This is sort of like you buy it and then you set it and forget sort of strategy. So if you want a 100% customizable solution, that brings me to a third way, and it's to build your own portfolio. And robo-advisors and diversified ETFs, they're pretty much a proven way where you can get reasonable returns with reasonable amount of risk and really no involvement on your part, which can be a downside for some people because it takes away that, you want to invest, you want to make money, you want to outperform the market, you want to research it. That kind of takes it all away from you, which is usually a very good thing because they tend to outperform people that emotionally try to trade. So if you're a young investor and willing to incur more risk and you want to build your first little portfolio consisting of individual stocks, this is what I came up with. I'm going to go to the computer in a second to show you all the stocks and their current prices. And I didn't use fractional shares for a few reasons. First of all, they're not readily available in Canada, and when they are, they have very high transaction costs. And even in the US, when say, you went to Robinhood and you bought a $10 Amazon fraction of the stock, because of how the roundup goes, sometimes the dividends, you might not get paid anything because the brokerage is just going to round up that little piece to themselves. The amount of the fractional shares that are available is limited, and really those shares are really only real inside that system. So if somehow Robinhood goes out of business, I don't know what you're going to do with a fractional share. So I wanted to build a portfolio that will, with the current stock price, fit within $1,000 without using fractional shares. Okay, so I just got to the computer to do that little portfolio. And remember, it's 100% customizable because for example, me, I like to invest in the companies that I use their products and I understand the industry and I understand their financials, but this can be different for you. So I work in digital marketing and I use Microsoft a lot, and so this is where I start. Their price in US dollars kind of fits this $1,000 portfolio. When you look at their total cash, they have 132 billion, but most importantly, when you look at their cash flow, it's at 45 billion. So if that was the only metrics I looked at, it tells me it's a pretty stable company. It has a lot of reserves, so this is kind of a safe stock. It's probably not going to grow in a crazy amounts like Tesla would, but it's a safe bet, and I think it will just grow in the future. So I would buy one share. I converted that into Canadian dollars because I know that for Canadians to invest $1,000 is even more challenging than doing it for Americans. So I didn't really want to cheat. So second one is Apple, and the reason I like Apple is because it's also a technology company. It might not be as innovative as it used to be when Steve Jobs was alive, but it's a solid company that, if we go to their cash flow, brings $71 billion in cash. So even if they don't go crazy with their innovations or anything, they just keep giving us boring iPhones, they will still make money. So that's another sort of a safe bet company for me. And because they did the stock split, that the stock again fits into my portfolio. And actually, I want to buy 3 of those, making Apple sort of the largest buy here. Because for me, they're both sort of a safe investment, but also if they manage to do some sort of innovation, they will jump up in price like crazy. So this is like both like safe and sort of a growth stock. All right, so the third stock is RY, which is super boring. It's Royal Bank of Canada. It's number one bank in Canada. It has assets in US as well. They have crazy amount of free cash flow. And even if they get hit by pandemic, this kind of a stock is not going to fluctuate a lot. It's going to go slightly down, slightly up. The fees are always rising in the bank. Bank is like casino. Bank is always making money off you, and if it's number one bank, that means they're making number one amount of money in Canada off us, which I can own. So I got 2 shares, and again, it diversifies me from the technology stocks. So I had $77 left in my portfolio, which is less than 10%. And I thought with this portion, less than 1%, I can take more risk for potentially like a higher reward. So I was thinking about the industries that I really like, that I know will be growing. And for me, that's cybersecurity. We all know with the pandemic, people are getting more and more online, which means there will be more and more attacks and hacks. So cybersecurity is important. So I looked at top 3 cybersecurity stocks, and number 1 was actually Cloudflare, which we use a lot for our clients. But the problem was that with the Cloudflare, everybody knows about that stock, everybody's buying it, and from what I can see, it's like overvalued. And because those companies are at the investing R&D stage, you can't just use their financials to do like a clear valuation. So this is again like a risky play. So I look at this company and they were down a little bit, but they seem to be doing well. They seem to have a solid business plan and a management team. So as a last piece of portfolio, I put 5 stocks. This is my cybersecurity portion, and this is also my like risky portion. So in the end, it was like minus $6.15, and you can still fit it with it. With $1,000, you just gotta set your targets when you buy the stock just a little bit lower than what I see right now at the quote, and just wait till somebody sells or wait for a red day, and you'll be able to fit that in $1,000. So as you can see, with $1,000, there are multiple ways on how you can invest it. You can go with robo-advisors that will give you a great interface with some limitations. They'll charge you a little bit more than ETFs, but they'll give you that automatic saving, the nudging to save. If you really want to save money on management, go with Diversified ETF. And the third way, it's not as boring perhaps to buy individual stocks, but long run, it is very hard to outperform algorithm portfolio or like the guys that are doing it day to day with their formulas and computers analyzing everything. I think regardless what you do, if you manage to pay down your high interest debt, you have emergency fund, and you want to invest in the stock market, kudos to you. You're ahead of a lot of people. And I just wish you luck. Thank you for watching, and until the next time.